This is Market Watch, and of course, starting with the oil share index, the benchmark NGX oil share index inched up 48 points to close at 98,169.0. The percentage change we see here is 0.05%, and what that gives us is a one-week loss of 1.68%, a four-week loss of 5.96%, but an overall year-to-date gain of 31.29%. And now let's take the market capitalization right here. For market capitalization, we have this. That's a 55.53 trillion. Now that's the market capitalization. And of course, right now let's go to the top movers. And for the top movers, I think it's even important I state here that in terms of volume and value, Zenith Bank actually led the pack. We can see what we have right here. You know, it also dominated trade value. And then looking at all of this, we have Access Corp here by volume, 39.88 million, Transcorp, 28.47 million, UBA, 22.94 million, and then we have Nigerian Breweries, 20.30 million. You know, that's what we have right here. Of course, looking at all of this, you know, total trade value, looking at all of that, but then that dropped to 31.95% to 6.52 billion naira. Now, moving away from that particular one, let's take a look at the top gainers from yesterday's market activities. For gainers, we have Transcorp Hotel, 9.75%, Livestock, 9.42%, Tantalizer, 9.38%, Suno Assurances, 7.44%, and we have WAPIC, 6.15%. We have the closing price from yesterday's market activities here. Now to the top losers. Looking at the top losers, we have Sterling Nigeria topping this particular chart by losing 9.69% of its share price. And away from that, we have Computer Warehouse Group, 9.57%. We have International Energy Insurance losing 9.30%. We have TIP losing 9.09%, and of course, Ometech losing 8.43%. And for sectoral performance, you know, one of the things we see is that the banking sector was actually mixed. We had UBA, you know, rising 0.44%, but others like the FBN Holdings, Zenith Bank, Access Holdings, and GTCO all declined. I also saw, you know, several other companies like Dangote Cement and Seplat, all of those, you know, staying steady, and that's why you always have your oil and gas steady here, and that's why you have the industrial goods steady here. But talking about the banking sector, you saw what I showed you the other time, you know, it declined, especially because when you look at Zenith Bank, which had the top volume and value from the market activities yesterday, it went down, and that's one of the reasons we have this here. That's a dip in the banking sector, minus 1.10%, insurance plus 0.88%, oil and gas, I talked about that earlier, we know why. Then consumer goods minus 0.05%. Of course, I've also talked about industrial goods earlier, which closed 0.00%. We'll take a break now. When we come back, we'll have our first conversation on the show today. Stay with us and go away. Glad to know you stay with us. A former director of the British Council in Nigeria, David Roberts, has called on Nigeria to reject the recent report by the International Monetary Fund, IMF, which projected that the country would drop from the first to the fourth largest economy in Africa this year. The fund, in its recent World Economic Outlook, as reported by Bloomberg, estimated Nigeria's gross domestic product GDP at $253 billion, behind South Africa with $373 billion, Egypt $348 billion, and Algeria $267 billion. However, the former British envoy to Nigeria said the country should rely more on data from its statistics rather than foreign agencies because the domestically gathered information is likely to be more accurate. Well, I'm now joined by Dr. Muda Yusuf, the CEO, Center for Promotion of Private Enterprise, CPPE. Thank you so much, Doctor, for joining me today.
Thank you very much, Perpetual. Thanks for having me.
All right, so looking at this, I mean, it's interesting to hear this from a former director of British Council, knowing how, you know, some Nigerians would jump on anything from the abroad, you know, whether it's data or finished goods. What do you make of this?
Well, I think what he has said is very correct. It's all about, you know, having confidence in ourselves and having confidence in our institutions. Because you know, our own institutions have much better access to data, more current data. They have better access to information around what is unfolding in the economy, in terms of economic activities, in terms of economic reforms, and the kind of outlook that all these reforms portends for the country. If you Google Nigeria GDP, you know, you will see different figures, actually. But most of the figures are well over 400 billion US dollars. That was as at, 2023. So we cannot just drop from about 450 billion or 430 billion dollars in 2023 now to 253 billion in 2024. I mean, that is, of course, a gross underestimation of what the size of our economy is. So for me, I don't think this is something that we need to reckon with that much. So I agree with the diplomats that made this comment that we shouldn't bother so much about it. Our economy is doing well. I mean, partially, our GDP growth as at the fourth quarter last year was about 3.4%. Not many economies are doing that well. And between then and now, of course, we have had some challenges around the cost of living, cost of production, and things like that. But all of these are outcomes of current reforms. It's all about resetting the economy. And things are beginning to take shape. We are increasingly now relying less on importation of petroleum products. We are trying to reform the foreign exchange market.
Okay.
A lot of inflows are coming into the economy. So the outlook is not as bleak as has been painted by the IMF.
All right, let me come in here. So, I mean, in essence, what you're saying is we should, totally dismiss, this particular projection from the IMF.
Yes. It's not something to reckon with that much. And what is even more important as far as economies are concerned, it's not even so much the GDP. It's about the welfare of the people. It's about jobs. It's about employment. If you listen to many of the assessment of economies in the advanced economies, they don't talk so much about GDP. They talk more about employment. They talk more about how the welfare of the people, housing deficits, the quality of infrastructure, how well are people feeding, what is the standard of their living in terms of all of that. For me, I think that is much more important. Even to the average Nigerian, if you talk about GDP to them, GDP is improving, GDP is dropping, it doesn't mean anything to them.
All right, let me come in here. I like what you said.
Yes.
Go ahead. You can land on your thought.
No, what they want to see is an improvement in their standard of living. Full stop.
All right.
GDP doesn't mean much if it doesn't translate to improve their standard of living. So we should focus more on what we call the standard of living index or human development index. And if you look at our performance on that index, we are not doing well at all.
So at the end of the day, I mean, from what you just said now, it feels like we still need to pay attention to the GDP. However, beyond that, you're looking at, things like infrastructure, welfare of the people, and employment. We know that these things, when we look at these three things you've talked about, Nigeria isn't doing so well. So what more needs to be done to improve this? Because at the end of the day, when these things are addressed, automatically the GDP will pick up.
Yes, I mean, well, the government is already on course as far as some of these things are concerned, because we need to address issues of productivity, for instance, because you cannot improve the well-being of the people. You can't, make the economy more inclusive if productivity is low. And productivity has a very strong relationship with the quality of your infrastructure. We need to look at our industrialization. It's very difficult to industrialize, to ramp up production if you don't have supporting infrastructure, especially power and logistics. Those things are very important. Then you also need to focus more on building an economy that is inclusive, because increasingly we are seeing a widening of gap between the rich and the poor. Inequality is becoming a major issue. The level of poverty is increasing. I mean, we have seen that in the past, when we had very good performance on account of GDP, and the people are getting poorer. We are having more unemployment. So we need to address, some of these policy issues, but more importantly, the structural issues, and how we can use fiscal and monetary policies to ensure that those at the bottom of the pyramid are not left behind. Those things are very important.
All right.
The more people you leave behind in the economy, the more you create problems of social instability, the more you create problems of insecurity. So as much as possible, we should bring everybody on board, at least to ensure that people have basic access to basic things of life. That is more important than the GDP.
Okay, thank you for that. Well, I'd like to take you back to the projection. Now, IMF projected a 2.9% growth for Nigeria in 2023. However, according to NBS report for fourth quarter 2023, which you alluded to, Nigeria's GDP grew by 3.46%. That was in the fourth quarter of 2023. But when you look at it on an annual basis, Nigeria's growth in 2023 was actually 2.74%. Now, that fell short of the IMF's projection. Don't you think that's some reason to probably take these projections seriously, and rather than be condemned to them, we make effort to change the tide? What do you think?
No, the government is aware that we have challenges in the economy. The government is quite aware. I mean, the last few months have been very challenging for production, for investors. And it is investment activities that actually drive the GDP. The government is quite aware of that, and that is why some of these reforms have been put in place to be able to ensure that you have, stronger macroeconomic fundamentals. Because you can't build something on nothing. You need to have the fundamentals right. Fundamentals around, bringing down your inflation, ensuring macroeconomic stability, strengthening our fiscal consolidation aspirations. Ensuring that we have an economy that is more inclusive, addressing the challenges of SMEs, promoting energy security. These are a combination of things that the government has been trying to put in place. So no one is in any doubt as to the fact that there are challenges in the economy. And last year was particularly very challenging because of the shocks of the reform. When you have major reforms, normally you have shocks. And those shocks, of course, in the short term, had some negative impacts on the welfare of the citizens and even on investors. But we are beginning to recover from that. And that is why I would say that, perhaps we have gone past the worst of the challenges in the economy. Going forward, the trajectory, I think, is such that the future will be much better than the past. That is what I think. So the government, I'm sure, is conscious of that. Of course, there are still a lot to be done. That is why consultation is very important. Consultation with stakeholders, to understand what the issues are with the economy, particularly from investors, and particularly also to ensure that you have more foreign direct investment to complement whatever we are having with the local investors. But I'm sure that progress is being made from the data you read out. There's something to show that the economy is in contraction. There's something to show that the economy is heading for recession. So these are things that are positive, and I think we should be more positive about the economy going forward.
All right, so taking a general look at gross domestic product, at current price, it's actually defined based on the GDP in national currency converted to US dollars using market exchange rates, looking at the yearly average. Now, this means that improvements in Nigeria's currency can and actually should set Nigeria up for more growth. Now, beyond the quick fixes and some form of administrative management we have seen so far in the foreign exchange market, what are your recommendations for long-term solutions? Because it feels like the Naira is probably beginning to depreciate all over again.
No, what is important is to have a framework to ensure minimum volatility, to have a framework for stability in the exchange rate. Now, I've heard the CBN talk about the fact that the CBN wasn't going to defend the Naira and that it is willing buyer, willing seller. But what I would like to suggest is that we should not leave the Naira completely to a floating regime. What I thought we had adopted was a managed floating regime of the currency. And that is what is done in most economies. You don't leave your economy completely to free market. You intervene in the market depending on the prevailing circumstances. Sometimes we intervene to make foreign exchange supply to the market. Sometimes we intervene to buy from the market when there is evidence that there's a lot of foreign exchange liquidity. So depending on the circumstances, the CBN has a responsibility to intervene. One of the main objectives of having your reserves apart from paying your debts and settling some obligations that is due to governments, whether states, local or federal, foreign currency obligations. One of the main objectives of the reserve is also to support the currency. So depending on how the situation is swinging, the pendulum is swinging, the CBN has a responsibility to define a corridor within which to ensure that the currency doesn't swing beyond. And we can do that, and I think it's possible. If you have proper econometric modeling, we can come up with a range, something like an asymmetric corridor within which we should not allow the currency to be swinging. Otherwise, if you have this kind of volatility, it can cause a reversal of the gains that you have seen in the last few weeks.
Let me come in here.
Let
me come in here, Doctor.
It can lead to more people now losing confidence, and confidence, has a way of fueling speculative activities. We'll be back to square one.
All right. Now, beyond, some of those things that the CBN is doing or that the monetary authority is doing, what more can we do to ensure that, we have, more liquidity in the foreign exchange market? Some persons are talking about production, boosted exports and all of those things. I'd like you to also, comment or talk about those other things we can do beyond what the CBN or, let's say, the monetary authority is doing.
Well, I've said what the CBN should do to minimize volatility. That is extremely very important. That is having the right framework in the foreign exchange market. The other thing we need to do, and which we are already doing anyway, is to be able to ensure that we minimize import dependence, through a structured, sustainable strategy of import substitution. An example is what is happening already with our petroleum products. Up until now, we spend about 30% of our foreign exchange on importation of petroleum products. Now, with the coming on stream of the Dangote Refinery, even though we have not started seeing the production yet of PMS, but we are beginning to see the impact on diesel, we are beginning to see the impact on aviation fuel. So the more of this import substitution that we do, the lesser the pressure on the foreign exchange market. You can also extend that to other sectors, supporting non-oil exports, for instance, so that you can have more exports, supporting even the growth of oil exports, oil outputs. All of these things are in the fiscal policy domain. They are not within the CBN domain. So they are within the purview of the fiscal authorities to ensure that we ramp up our production in oil outputs by ensuring that we have minimum this oil theft problem, insecurity. Only recently, the president has put in place some initiatives to improve incentives for investors in the oil and gas. That kind of incentives can also spur a lot of investment, because the more FDI we have in the economy, the more foreign exchange we also have, and that also helps to stabilize the currency. So there's a whole lot that can be done around investment, both to boost earnings of foreign exchange.
Dr. Muda, if you can hear me, I think I'll...
Yes.
Okay, so just before we close, I would like to go back to some of the things the former British envoy alluded to, and I'm sure that you've mentioned some of them, but I'll just say these things in his words. He said, fuel importation is down by 57%, local refining is up by 12%, and will explode when the Dangote and Port Harcourt refineries kick off fully. You no longer spend 1.5 billion naira a month floating the naira. Now, I want to ask you, if this momentum is sustained, how long, in a matter of, I wanted to put this in a matter of, maybe weeks or even months or years, if this is sustained, how long will it take us to reach, that promised land, really?
Well, promised land that's a long journey. What we want to see is an improvement in the currency stability, the strengthening of the naira, the creation of more jobs and all of that. It's an incremental thing. It is very difficult to define a terminal date for reaching the promised land. It's a long journey. Even the advanced economies are also struggling to grow. But what is important is to ensure steady growth, to ensure that steadily we ease poverty, steadily we address all the key business environment issues, we address our insecurity issues, our infrastructure deficit, our macroeconomic stability. Those are the key fundamentals that we should begin to address. And the more we make progress in that front, the closer we get to what you have described as the promised land. I think that is the way to go.
All right, thank you so much, Dr. Muda Yusuf, CEO, Center for Promotion of Private Enterprise. Thank you so much for your time on the show and for sharing your thoughts with us.
Thank you very much. Thank you.
Glad to know you stay with us. With economic uncertainty looming and market volatility on the rise, many investors are feeling anxious about their portfolios. How can you weather the storm and keep your investments safe? Here, we speak to a financial analyst about safeguarding your investments during challenging economic times. Well, her name is Nabila Mohammed, research analyst at Chapel Hill, Denham. Thank you, Nabila, for joining me today.
Thank you for having me. Good morning.
Wow, I see we're wearing the same color. Interesting. But first, I'd like you to acquaint us with available investment instruments, in the Nigerian market and maybe a few others, outside the country. I would like us to begin from that before we then delve into, the main issue.
So, as you know, not just in Nigerian markets, even in the outside markets, we have different forms of investments. We have the fixed income instruments, ranging from the euro bonds, the CPs, the treasury bills, all those fall under the fixed income instruments. And we also have equities, that's the stock market. We have mutual funds, that's like traditional mutual funds that we have in the country and even outside the country. We also have alternative investments as well. That's the real estate, the infrastructure funds. All these are different forms of investment vehicles that investors can, use to have returns at the end of the day. So basically, those are the major forms of investments that you find everywhere, both within and outside the country.
All right, so let's look at the equities market in Nigeria because it seems to be the one in the eye of the storm, basically. So looking at that particular time, this somehow doesn't look like a good time for people in that particular sector.
So really, it depends on perspective because for different investors, they have different outlook to why they are investing in certain instruments. So wherever you are standing at, the perspective that you're looking at in terms of the investment opportunity that you've decided to go into is what will determine whether this time is right for you or not. And I'll give you an example. So if we're looking at it as an equity investor, if you have a long time horizon, you already know that you're locking in your funds in a risky form of investment, and that's what equities stock market really is about. So definitely we would see some form of volatility along the line, largely driven by maybe policies in the macroeconomic climb, also driven by corporate actions, also driven by just basic market sentiments. And really the time, year to date, we have a return of around 31.3%, and it is quite a huge number if you're looking at year-to-date inflation. So if you are looking at the time and maybe lately in the last couple of weeks, we've seen some form of bearish sentiment in the market. It's not uncommon to have that, especially if you're an equity investor. It's just a matter of how long your horizon in terms of investment is and what really you're looking at in terms of that form of investment, which is the equities market. Equities market, like I earlier mentioned, is driven by a lot of things. Market sentiment is there, that's forces of demand and supply. We have corporate-related driven actions that would spur sentiments in that particular stock that maybe an investor is invested in. Just like we had news around PZ and how it's affected the share price. So some of those things are really what will drive market sentiment. And it is also very dependent on your perspective to investment. So if you look at this time where prices are depressed for some of the key stocks, it will be an opportunity for someone to take advantage and take positions in those stocks. But if it's also another person's point of view, the person might decide that I would want to, sell average my cost and sell and take profits for now and come back in when I feel the prices are much more attractive. So really, it's a perspective thing and how you view the market in terms of investments generally.
All right, so looking at equities market, I know that to a very large extent, the banking sector has really, dealt the market a heavy blow. So I'd like you to, just specifically address people, who are in that particular sector. What's your thoughts? What should they be doing? We understand the recapitalization thing is starting as soon as possible. But what do you think? I mean, how should they manage their portfolio at this time, their portfolios?
So really, the banking sector is one sector that I feel like is very interesting, given all the policies around it that has come out since the start of the year. And I would describe the recent tanking in prices of the banking sector largely as a result of, I would like to call it a herd mentality, just everyone following what every other person is doing. Because when you look at the fundamentals, in fact, let us even start from the macroeconomic climate and see how favorable it is for the banks at this point in time. Yields are elevated, and we know that banks are in the business of lending. They are also in the business of trading, and that simply means that they are going to tap into this high interest rate environment, and this will feed into their interest income at the end of the year. So regardless of the recapitalization, which is even a 24-month long exercise, meaning they have a long time to even get to that capital levels as disclosed by the CBN, they are still going to be doing their business. Business will still be good for them, especially now that yields are at all-time high. They are going to tap into that, and they are going to translate that into interest income at the end of the day. So if you're holding stocks, if you're already an existing investor in those banking names, you should be looking at the long-term view of how this particular sector is going to play out. They're going to come out stronger at the end of the capital raising exercise, that's no doubt. They are still in the business of lending, and yields are elevated currently. So even in the short term, their profitability will still be strong. They will still declare dividends. We should not also forget that in the equities market, the banking sector also provides the most liquidity when we are looking at the volumes and value traded that moves the market on a daily basis. So all these are positive things that I feel at these depressed levels, if you want to still take position in these stocks, you will still see value in investing in the banks at this time, regardless of the recapitalization plans. Just looking at how their core business and how it will impact their profitability at the end of the day. So these are the things I feel investors should be looking at. It's okay to take profits when you see the opportunity, but when you have a long-term view, I mean, you shouldn't be worried about the current, the levels that we're seeing it, because if you look at the fundamentals driving the businesses of the banks, you would know that they are still in business, and the business is not just for the short term, but also long term.
All right. Well, still on the equities market, are there other, sectors or specific stocks with strong fundamentals that may have been relatively safe, during this period, for people who want to rebalance?
Well, if you look at the equities markets, we understand that the macroeconomic environment has, largely affected how some of these sectors have responded. Let me talk about FX now. For the consumers, we know they were hit largely by FX losses given the devaluation that occurred last year, and also at the start of 2024. But then we are also seeing them taking measures to correct these losses. Is ranging from debt to equity conversions by some of these consumer names, even them just looking inwards and trying to make sure that they come up with innovative products that will be tailored towards their different consumers. It just simply means that this impact of the FX losses on their books is going to be short-lived, and we'll definitely see them rebound, especially when we start to see some form of stability in the currency. And besides, the outlook for the currency this year still looks positive, given some of the policies and the exercises that the CBN has embarked upon in order to defend the currency or defend the naira. So if that happens, we'll definitely see that trickle into the performance of the consumer names, and we'll see them revert back to the levels that they used to be pre the devaluation exercise, and also see them start to declare dividend again. Besides, we've also seen the likes of Nestle also come out to say that they are going to start to revalue their assets in order to come out of the negative equity position. All these are key things that these companies are actively working on in order to address the losses that they must have booked previously. And that will tell well for investors, because it also means that the company will be profitable going forward, And if the company is profitable, it would mean that shareholders would have something to enjoy. In fact, I wouldn't be surprised if some companies decide to reward their shareholders for not paying them dividends in this immediate past year by paying them some form of bonus or something going forward when they start to record profits. So consumer sector is also one very good sector to look at, given all the things that some of the companies therein are trying to do to come back to profitability. We also have the telcos as well, especially MTN. Even though we've seen the losses, that company is, is a very strong company fundamentally speaking. And if we look at some of the things that they are also doing to bolster their profitability, I mean, it is also good investments to look at as far as equities is concerned.
All right, so away from the equities market, I mean, you've said a whole lot. I'm loaded right now, and I think everyone watching is loaded also. But give us a sense of what's happening in the fixed income market.
The fixed income market has experienced something very interesting since the start of 2024. I mean, we've seen yields from an average of around 13% at the end of last year, almost reaching an average of 20 and above. In fact, sitting comfortably around above 20% on average. And it's largely because of what the CBN is trying to do, rein in inflation. So they are maintaining a tight monetary policy stance and hiking interest rates accordingly, mopping liquidity from the system. And also we've seen some form of support in that line from the fiscal side with the aggressive borrowings that they started the year with. All this translated to high yields in the fixed income market. And what we are seeing now, we even saw something remarkable happen earlier this year with the bond yields crossing 20%, something we haven't seen before. So really, the fixed income market is also such that if you are a new entrant into that space, you'll be buying at high yields, and that is very good investment, given that we don't expect this high interest rates to continue for a very, very long time. It means that at some point in time, there will be a reversal and we will see some form of appreciation in your returns on investment. So the fixed income market really has experienced some form of interesting turnaround, given just what the stance is generally in terms of reining inflation.
All right, so talking about mutual funds now, that seems like an instrument that spreads, one's risks, but that is also dependent on the percentage spread. I mean, if you have a mutual fund where maybe 40% goes to equities, you're still not, I don't want to say you're still not so safe. So, how should an investor in that instrument mitigate his or her risks?
So really, it is not even the headache of the investor to bother about how they should mitigate their risks. Largely the portfolio manager that is managing the funds. Yours is just to give them the money and...
You know what, Nabila? This is more like a personal experience. I watched my money go down. I watched the interest wipe off, and then I watched my capital go down. I can't sit down and wait for...
I would say that for mutual funds, really, you should be looking at mutual funds that are well diversified. And if you're... you should, as an investor, you shouldn't just, go and sit and wait and allow someone else to manage your money. You should also monitor the market. So if you want to invest in a money market fund, now is actually a good time, given that money market funds invest in, largely liquid instruments. That's treasury bills, and we know what treasury bills yields are doing. We're talking 25, we're talking 25, 27 levels in terms of yield. So that really is one mutual fund that you should be looking at, given the current macroeconomic climate. Another mutual fund that you should be looking at are those that invest in dollar-denominated assets. That's the Euro bonds. Because if we're factoring in the depreciation or devaluation in the currency on your returns, you would be in so much money. In fact, just to give you context, on a year-to-date basis, if we had factor in the devaluation of the currency, assuming you started the year with a $1,000 investment, you'll be talking 45% return year to date, which is above what the equities market is even doing. So if you want to really enjoy the mutual funds. You should be looking at mutual funds that are invested in what is favorable currently in the macroeconomic space. If you're looking at bonds, you've got bond funds. You're looking at money market instruments, you've got money market funds. If you're looking at dollar-denominated assets, look at dollar funds. So those are really the mutual funds that you want to be invested in order to enjoy returns on your investment and also preserve your capital.
All right, thank you so much, Nabila Mohammed. I listened so much that I lost track of time. Thank you for sharing your thoughts with us today.
Thank you for having me.
All right. Well, that's it on Business Edge today. Many thanks for watching. I am Perpetua Fasol Repeater. Bye for now. See you next week.